Welcome back to Brother Dogs Finance. Today we are going to talk about one very important valuation metric, the free cash flow yield, FCF yield, or the reverse of it, P to FCF ratio. In this video, we are going to explain what exactly the ratio is, how good it is from stock selection perspective by showing the historical study results under the SP 500 universe, and more importantly, how we can leverage it to improve return profile of our own investment portfolios. And let's get started. So, what is free cash flow and how it is different than another important financial metric, the net income? By definition, free cash flow measures the real cash flow available to company shareholders, while net income simply represents the profits of a company from accounting standpoint. And as a result, free cash flow needs to further take out expenses such as capital expenditures, the CapEx, from the net income. Let's still use our previous Brodog's Pizza restaurant as an example. Each month I'm making 50K by selling pizzas, which is my revenue, with direct costs of 5K rent, 10K recipe costs, 10K for hiring staffs, and another 15K for taxes, leaving me 10K, which is my net income here. However, when running the business, I also need to upgrade and maintain the cooking assets, such as buying new baking trials, upgrading baking ovens, and etc. And all these so-called capital expenditures will be further being deducted from the net income when calculating the free cash flows. With that said, free cash flow really represents the amount of money that I can use under my discretion, such as investing in R&D, research and development, by creating new pizzas or advertising on internet, giving coupons or discounts to customers. To conclude here, similarly on stock market, the free cash flow refers to what a company has at the end of the day, which could theoretically be distributed to shareholders by paying out dividends, or creditors by paying back the debts, or any other discretionary uses determined by the management team, which is the most direct measurements on the financial flexibility of a company. And what's more important about the free cash flow is when investors determine the fair value of the company. One popular method is to discount the future free cash flow the company can generate back to today, basically the DCF model, and come up with where the stock price should the company be traded at, emphasizing that free cash flow concept is almost the core of valuing any companies. Intuitively, for two companies that are running similar business models, their free cash flow yield, which is the ratio between free cash flow per share and the stock price, should be comparable to each other. And formula-wise, free cash flow yield tells information on what the offer price investors would like to provide per unit of discretionary cash generated by the company's model, the business model. So if one company's free cash flow yield is significantly lower than the other one that runs very similar business, it would mean the company is being overvalued, with the other one being undervalued. Again, the Pepsi versus Coca-Cola example. Currently, Pepsi's free cash flow per share is $3 with stock trading at 174.16. So its free cash flow yield is to use the free cash flow per share divides the stock price equals to 1.7%, while for Coca-Cola the free cash flow yield is 2.3% from the same calculation, which is higher than Pepsi's figure. So as a result, what it suggests is compared to its price, Coca-Cola can generate higher level of free cash flow than Pepsi, meaning Coca-Cola stock price is being undervalued relative to Pepsi. And for value investors, it's better to go with Coca-Cola rather than Pepsi when considering to invest in the soft drink business. And up to here, I hope the concept of free cash flow yield makes good sense and sounds straightforward. For next part of the video, we will still utilize our quantitative testing framework to test the real efficacy of free cash flow yield by tracking its historical performance under multiple stock market indices. As a reminder here, a brief introduction to our 5-step quintile quantitative testing framework. Looking at the chart here, step 1, we choose a stock market index as our study universe. It could be anything such as SP 500, Russell 1000, or Russell 2000. Then step 2, for the selected universe, we split it into 5 quintiles buckets based on each month's end free cash flow yield values. And we call these quintile buckets Q1, Q2, and up to Q5, where Q1 includes those stocks with the highest free cash flow yield values, the most undervalued stocks, and Q5 includes those with the lowest free cash flow yield values, the most overvalued ones. After that, the step 3, for each quintile that formed at the month's end, we calculate the average stock return during next month and use that as a monthly return for the quintile. Then in step 4, we simply repeat step 2 and 3 each month during the whole study period, which is from 2000 to end of 2023 here. Now we should have the monthly returns for all these quintiles. And in the last step, we calculate the annualized return and risk figures of these quintiles and see if the numbers support the idea that higher free cash flow yield quintiles can deliver better returns or not. And here's the result for SP 500 universe. The quintile pattern looks really promising. Annualized returns for stocks with highest free cash flow yield, basically those undervalued ones, deliver 12% a year versus those lowest free cash flow yielders, which only generate 6% per annum. What's more important is that the pattern looks really monotonic, further enhancing our previous theory that free cash flow yield can help to predict stock future returns. In addition to the annualized return chart, we also plot the cumulative return difference between Q1 and Q5. Essentially, we are assuming we always long the stocks with highest free cash flow yield and short the ones with lowest free cash flow yields. Looking at the trend of the cumulative return line here, it's really impressive that the line goes up almost all the time, indicating that high free cash flow yield stocks outperform low free cash flow yield stocks all the time. And this is a very strong evidence for us to believe in the fact that free cash flow yield is really adding huge value. Combining the annualized bar chart and the cumulative long-short return chart here, I think we should agree on the fact that as value investors, free cash flow yield is one of the most important indicators we should look at when selecting stocks. Lastly, we further look at the similar charts for free cash flow yield under broader indices, the Russell 1000 and the Russell 2000. First, the annualized return bar chart here for quintiles. Same conclusion. Free cash flow yield clearly distinguish between winners and losers on the stock market, while the effect is more prominent in Russell 2000. That's the annualized return from top 20% free cash flow yield stocks being 15% and the bottom 20% of free cash flow yield stocks being negative 3%. The difference here is really huge. Then next, the long-short cumulative returns. As expected, free cash flow yield adds value across the whole time frame and is more significant under the Russell 2000. Meanwhile, it's worth noting that though Russell 2000 shows the best performance for free cash flow yield factor, the universe itself includes much more small cap and potentially illiquid stocks compared to Russell 1000 and SP 500, which we should always keep in mind about this when we do the real trading. A quick recap. The free cash flow yield is a very important valuation metric for value-driven investors, as it has the ability to separate out the undervalued stocks from overvalued ones. And such capability is proven to be robust under different major market indices during the past 23 years. That's all about it. And before the end of today's video, we would like to emphasize that even the free cash flow yield is a golden metric to use. It's always better to look at stocks not just from one single aspect, but multiple angles. For that purpose, our factor scoring system, which can be accessed via the URL link below, helps us to do that, where we come up with an aggregated score for each stock that considers the valuation, quality, growth, momentum, volatility of a company, where free cash flow information can also be found in the spreadsheet there. Feel free to check it out. I hope the video is very helpful. Don't forget to subscribe and stay tuned. And I will see you soon.